Okay, these are my notes from the 2003 Berkshire Hathaway meeting. These are some of the best parts, the most useful or practical things that I thought would be worth writing down. 6% a year return in a low inflation environment is good. Inflation is the investor's enemy. You need higher returns on your investments if there's high inflation. Real income per capita grew sevenfold in the 20th century. The best way to learn accounting is to read good business articles, also reading annual reports, said Warren Buffett. And if it's obfuscated or difficult to understand, the management probably doesn't want you to, so stay away from it. Warren Buffett said, "A few mistakes will overcome a lifetime of savings. There's nothing more deadly than unrecognized concentrations of risk, but it happens all the time." There was a question on how far out in the future to look when buying businesses. The answer: we're going to hold these businesses forever, so we want a business that we think is going to have, if run well, some kind of competitive advantage over many decades. We're not going to resell them. And we better have something that's not only good now, but is going to stay good. So we don't buy hula hoop companies or pet rock companies, and we don't buy companies and industries that we think will have great explosions in demand, but where we don't know who the winners will be. Warren's quote on happiness, he said, "If we could buy $1 million worth of love, it'd be a lot easier than being lovable. Being loved by the people you love is considered success. Give love to give it. Look around at older people than you, and you'll not see an unhappy person who's not loved by the people around them." Here's a good quote on buying good businesses versus buying cheap cigar butts. "If See's Candies had asked $100,000 more, Warren and I would have walked." So this is Charlie Munger speaking. "That's how dumb we were. Let this be a lesson to you. And one of the reasons we didn't walk is, while we were making this wonderful, stupid decision, we weren't going to pay a dime more. Ira Marshall said to us, 'You guys are crazy. There are some things you should pay up for. You're underestimating quality.' Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind, and that is a very good lesson for anyone. The ability to take criticism constructively is think of all the money we made from accepting that one criticism. And if you count the indirect effects from what we learned from buying C's, you can say that Berkshire has been built partly by learning from criticism." Warren said, "If you can't sleep at night worrying about your stocks, you shouldn't own them." Charlie then said, "I think that the fretful disposition is the enemy of long-term performance. It's almost impossible if you're to do well in stocks over a long period of time," said Warren. "We'd be happy to own our companies even if they closed the stock exchange tomorrow. A lot of people have private companies and they never get a quote on them. We bought See's Candy in 1972 and we haven't gotten a quote on it since. We look at the company results. If you focus on share price, it really means that you think the stock market knows more than you do. The stock market is there to serve you and not to instruct you. We want to buy more when prices fall. Our mistake was not buying more when Walmart went up." Warren says he doesn't give a hoot about what management says they're going to do in the future or projections. "Knowing basic business numbers is important. Analyst reports are worthless. You only have to be right on a very few things in your life as long as you don't make any big mistakes," said Warren. Charlie then said, "Analysts think they can go through each company and evaluate where it'll be in the future and beat the market, but they can't." Warren said, "Wait for the fat pitch. The way to get a reputation for being a good businessman is to buy a good business. It's much easier than taking a lousy business and showing how wonderful you are at it. I haven't seen that done very often." Warren said, "I don't worry about what I don't know. I worry about being sure about what I do know. Depreciation is a real expense, so don't look at EBITDA or EBITDA. The D should be considered. D is depreciation. Whenever you hear EBITDA, just substitute the word bullshit earnings," said Charlie. Banking has been a good business. Some banks have ROEs or return on equities of 20%, which is very good. Historically, ROEs have been very good. Returns on capital have been extraordinary. Intelligent people make their decisions based on opportunity costs, says the economist professor at Harvard who wrote a freshman textbook, Mankiw. His name is Mankiw, Mankiw. On the ideal business. The ideal business is one that earns very high returns on capital and to keep using lots of capital at those high returns. That becomes a compounding machine. But there are very, very few such businesses. Unfortunately, the really good businesses like Coca-Cola or See's Candy don't require much capital, and incremental capital doesn't produce anything like the returns that we like. We love the business that could keep deploying capital no matter how much more we put in it, like 20%. Those businesses are so rare. There are lots of promises, though. Most of the great businesses generate lots of money, but they do not generate lots of opportunities to earn high returns on incremental capital. We can deploy X or X amount of dollars at See's Candy and earn a lot of money, but if we put in 5X, we don't earn any more money to speak of. There are no opportunities to use the extra capital. We take that extra cash and move it around to buy more businesses, said Warren. Charlie said, if you take a business that's a good business but not a fabulous one, they tend to fall into two categories. One is the business where the whole reported profit just sits there in surplus cash at the end of the year, and you can take it out of the business, and the business will do just as well without it as if it stayed in the business. The second business is one that reports the 12% on capital, but there's never any cash. There's a lot of businesses like that, where just to keep going or to stay in place, there's never any cash. Now that business doesn't enable headquarters to drag out all the cash and invest it elsewhere. We hate that kind of a business. Warren said, most businesses with the extra cash aren't very good at buying other businesses, but it's what we do. We go all in and never quit buying unless the price goes up. But our mistakes were not continuing to buy just because price went up. Good ideas are too scarce to be parsimonious with once you find them, said Warren. It's cost us money, many billions of dollars, not buying just because price went up. Those are opportunity costs that cost billions. They don't show up in the financial statements, but the amount of money that's been blown by dumb decisions at HQ at Berkshire Hathaway is awesome, said Charlie.